Hey everyone, silver just did something it hasn't done since 1980. It broke its all-time high. And while most people were watching the stock market gyrate and crypto do its usual circus act, a metal that fits in your palm quietly posted one of the best performances of any asset on the planet, surging over 130% in a single year. But here's the part nobody's talking about. How you owned silver during that run determined whether you actually made money, got wrecked by fees and decay, or sat there watching leveraged contracts expire worthless while the metal itself soared. Because silver isn't just one investment, it's three completely different bets: physical silver, SLV, and silver futures. Same underlying metal, totally different outcomes, totally different risks. And right now, with silver trading near $70 an ounce, and analysts at JP Morgan forecasting it could average $81 in 2026, this conversation has never mattered more. So today we're going deep. We're going to break down all three vehicles, look at what the data actually says, and then figure out where this market is heading next. Let's start with the thing most people picture when they think silver, the real thing. Physical silver is exactly what it sounds like. You're buying the metal itself, coins, bars, rounds, and you either hold it at home in a safe or store it at a vault. When you own physical silver, there is no counterparty risk, no broker, no clearinghouse, no CEO who can mismanage your asset into oblivion. If the financial system seizes up overnight, and history has shown us that it absolutely can, you still have something tangible and universally recognized. That's the core value proposition, and it's not trivial. The silver market has been in a structural supply deficit every year since 2021, with annual demand outpacing mine supply by roughly 160 to 200 million ounces in some recent years. That's a genuine physical shortage. And when you buy a silver eagle or a kilo bar, you're participating in that tightness directly. You own an asset that the market literally cannot produce fast enough. But physical silver comes with real-world costs people consistently underestimate. First, there's the premium. A 1-ounce American Eagle right now is trading anywhere from $5 to $10 above the spot price. That's your immediate cost to get in. You're already behind before silver moves an inch. Then there's storage and insurance, especially for meaningful positions. That's an ongoing annual expense. And when you want to sell, you typically get a bit less than spot unless you're selling to a private buyer or a dealer during peak demand. Liquidity is real but not instant, and if you're in a hurry, you'll leave money on the table. So who's physical silver actually for? It's for the person playing the long game, the investor who wants to own silver not for a 60-day trade, but as genuine wealth preservation over years or decades. It's for someone who genuinely doesn't trust the financial system to function smoothly forever, and wants insurance against a scenario most people don't plan for. And frankly, given what's happened with bank failures, fiat debasement, and geopolitical fragmentation in recent years, that instinct isn't crazy. It's just not a trading vehicle. Now let's talk about SLV, the iShares Silver Trust, which is the most popular silver ETF, and how most retail investors actually get exposure to silver. SLV was created to solve the physical ownership problem. You buy shares on the stock exchange. Each share is backed by roughly 0.93 ounces of silver held in a vault, and you get silver price exposure without ever touching a coin or worrying about a safe. It trades like a stock. You can buy it in a regular brokerage account, including an IRA, and you can get in and out in seconds. The expense ratio is 0.50% per year. Not nothing, but not outrageous. Here's the thing about SLV that's genuinely important. Over short to medium time frames, it tracks silver price quite well. If you bought SLV at the start of 2025 when silver was trading around $29 and held it through the rally that took silver to record highs near $70, you made extraordinary returns. That's the power of the instrument. Clean, accessible price exposure. But SLV has a dark side that comes out in very specific scenarios, and right now those scenarios are very much live. Something interesting happened in early 2026. Silver prices kept climbing, but global ETF holdings of silver were actually falling. Prices were going higher while ETF investors were selling, not buying. That tells you something important. The real buying pressure wasn't in the paper market. It was coming from somewhere else. Industrial users, physical buyers. And that divergence between paper ETF flows and physical market tightness is a risk factor for SLV holders that most people don't think about. There's also the small but real issue of counterparty trust. SLV is backed by silver held in a custodian structure. If you read the prospectus, and almost nobody does, you'll find that in certain stress scenarios, the fund's claims to the underlying silver are more nuanced than they appear. For most market conditions, this is irrelevant. But for investors who are buying silver specifically as a hedge against financial system breakdown, SLV is paradoxically one of the worst vehicles to use. You're using a Wall Street product to hedge Wall Street risk. The irony is real. SLV is at its best for tactical traders who want silver exposure for days, weeks, or a few months. Investors who want silver in a tax-advantaged account. People who want portfolio diversification with precision. Anyone who understands their buying price exposure, not silver itself. Now we get to the most powerful and most dangerous of the three, silver futures. Silver futures are contracts traded on the COMEX exchange where you agree to buy or sell a specific amount of silver, typically 5,000 ounces per contract, at a specified price on a future date. The key word in all of this is leverage. You don't put up the full value of 5,000 ounces. You put up a margin deposit, typically a few percent of the contract's total value, which means you control an enormous position with relatively little capital. When silver moves in your direction, the gains are multiplied dramatically. When it moves against you, so are the losses. A 2% move in silver's price becomes a 20%, 30%, or 40% move on your account, depending on the leverage used. Professional commodity funds, hedge funds, and sophisticated traders live in the futures market. It's the arena that actually sets silver's price, because COMEX futures volume dwarfs the physical market on a daily basis. There's a critically important concept in futures called roll cost. Contracts expire. Every month or two, if you want to maintain a silver position, you have to close your expiring contract and open a new one. If the futures market is in contango, meaning future contracts are priced higher than current spot, you lose a little money every time you roll. Over months, those losses compound. It's the silent killer of long-term futures positions. Futures are genuinely dangerous for retail investors who haven't studied them extensively. The 2020 crude oil event, when oil futures briefly went negative, is a real-world reminder that levered commodity instruments can do things that seem theoretically impossible. Silver futures won't go negative, but they absolutely can wipe out an account in a session if you're wrong-sized going into a volatile day. And silver is famously volatile. In 2025, silver surged over 130% for the year, but within that trend were 5%, 8%, even 10% single-day swings in both directions. With futures leverage, those swings are amplified into account-destroying events if you're on the wrong side without stops. That said, futures are the most efficient and cost-effective way to trade silver if you know what you're doing. No storage costs, no counterparty credit risk in the same sense as SLV, precise position sizing, tax advantages in many jurisdictions. In the US, futures often fall under the 60-40 rule, meaning 60% of gains are treated as long-term capital gains, even if held for a single day. For disciplined, experienced traders, futures are the sharpest tool in the box. So let's now look at where the silver market actually stands today and what's likely to happen next, because this is the question that cuts through everything. The silver market is forecast to record its fifth consecutive annual deficit in 2025, sitting at around 149 million ounces, smaller than prior years but still historically large. Industrial applications now account for over half of global silver demand. Solar panel usage alone climbed more than 25% in 2024, with newer high-efficiency panel technologies requiring significantly more silver per unit. Electric vehicles use roughly 2 to 3 times more silver than conventional gas-powered cars. Then add AI infrastructure, data centers, server boards, advanced semiconductors, all of which rely on silver in ways the average investor hasn't fully registered yet. Mine supply is projected to reach a 7-year high, but is still not coming close to meeting demand. This is the structural story, and it's not hype. It's a supply and demand imbalance that has now been running for half a decade. On the macro side, gold has been trading near $5,000 an ounce, pushing the gold-to-silver ratio into territory that historically signals significant silver undervaluation. That ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been running well above its historical average, and every time it has contracted sharply in the past, silver has outperformed gold dramatically. JP Morgan Global Research sees silver prices averaging $81 per ounce in 2026, which would represent a significant additional move from current levels. Meanwhile, more bullish analysts, including some at major institutions, are pointing to $100 as a realistic possibility rather than a fringe forecast. The majority of major bank forecasts cluster in the $50 to $65 range for 2026, with analysts citing continued ETF inflows, persistent industrial demand, and macro uncertainty as supportive factors. That more conservative band might seem at odds with the $81 JP Morgan figure, but the divergence reflects genuine disagreement about how quickly the physical market's structural deficit translates into price pressure, and whether investment demand can sustain the pace it set in 2025. Here's what matters for the three instruments in this environment. If silver grinds steadily higher over the next 12 months, say it moves from $70 to $85, that's a roughly 21% gain at the spot level. A physical silver holder captures something close to that, minus their premiums and any storage costs. An SLV holder captures it almost exactly, minus the 0.50% annual fee and any bid-ask spread. A futures trader on a single contract position with standard margin captures something like 200 to 400% of that move in dollar terms relative to their capital, but only if they stay solvent through every correction along the way, manage their roll costs intelligently, and keep position sizes rational. The scenario that separates the three most dramatically is a violent, fast spike, the kind of move silver made in 1980, and the kind of move that some analysts are watching for again, given the similarities in supply conditions. In a genuine price explosion over weeks rather than months, futures traders with established positions make life-changing returns. SLV captures the move cleanly. Physical silver holders make money on the metal, but may struggle to find buyers willing to pay spot or above in an illiquid, chaotic environment. That's the counterintuitive truth about physical metal during extreme spikes. The premiums become enormous, but actually converting that wealth to cash fast requires a functional market. The honest answer to the question this video poses, which one do you actually want, is that the right answer depends entirely on who you are. If you're a first-time investor who wants to participate in a silver bull market without complexity, SLV in a regular brokerage account is the most sensible starting point. It's liquid, transparent, low cost, and does what it says. If you believe in silver not just as a trade, but as genuine monetary insurance against systemic risk, you need some physical. Not all of your allocation, but enough that it would matter if paper claims on silver became complicated. And if you're an experienced trader who understands leverage, roll dynamics, margin calls, and position sizing, and more importantly, understands what not knowing those things cost you, then futures give you tools that neither physical nor ETFs can match. What you absolutely do not want to do is walk into any of these three instruments without understanding what you actually own, how it behaves in stress scenarios, and what your realistic exit looks like when it matters most. Silver has now delivered 3 straight years of strong performance. The conditions driving it, industrial deficit, monetary uncertainty, institutional reallocation away from overvalued equities, haven't gone away. Silver started 2025 near $29 and ended the year having broken its 1980 all-time high, in a move that forced every major bank to revise its forecasts. The market is telling you something. Whether you listen with a coin in your hand, a brokerage account, or a COMEX terminal is entirely up to you. But at least now you know exactly what each one of those choices actually means. If this broke down the silver market in a way that was genuinely useful, drop it in the comments and let me know which of the three you're positioned in. I'm curious what this audience is actually doing. Like and subscribe if you want more breakdowns like this one, and I'll see you in the next video.